Welcome. We're going to talk about corporate actions today. Now, from an institutional point of view, these events aren't really trading signals. They're actually data integrity challenges. And as you're about to see, if you misunderstand them, you can turn a really sophisticated financial model into nothing more than a statistical illusion. So let's dig into exactly how that happens.
All right, here's our game plan. We're going to start with the main problem, what we call false alpha. Then we'll go through the culprits one by one, everything from simple price adjustments to trickier issues like security identity and the really big one, survivorship bias. By the end, you'll see how these little details are actually the foundation of any real financial analysis.
So let's just jump right in with the single most important question. Honestly, it's something every quant, every portfolio manager, every risk analyst has to answer before they can trust a single result. And look, this isn't just some academic philosophical question. We are talking about the very real risk that a strategy that looks profitable on paper is just a ghost in the machine, an illusion created because a corporate action was handled incorrectly. It's the difference between finding a real edge and making a very, very expensive typo. First step, let's talk about the actions that people get wrong all the time. These are events that can make a stock's price and share count change dramatically, but, and this is key, they don't create or destroy a single penny of the company's value.
A stock split, it's really just a cosmetic change. The best way to think about it is like swapping a $10 bill for two fives. Yeah, you've got more pieces of paper, but the total amount of money you have is exactly the same. The company's market cap does not change one bit.
Let's look at a quick example to make this super clear. Imagine a company with, say, 3 million shares trading at 500 pounds each. They do a 2-for-1 split. Now, they have 6 million shares, but each one is worth 250 pounds. You see, the total value is exactly the same. No economic value was created. The pie was just sliced into smaller pieces. And the same thing is true for a reverse split. A 2-for-1 reverse split cuts the shares in half and doubles the price. But the key thing to look at is the market capitalization. It's $10 million before, and it's $10 million after. This is a purely mechanical adjustment. It is not a signal about the company's health or its future. Okay, so here's the really crucial takeaway for anyone doing data analysis. All historical price data has to be adjusted backward to account for that split. If you don't do this, your chart is going to show this massive fake price drop that never actually happened in reality. And that just completely breaks everything. Your volatility calculations, your moving averages, your performance numbers, all of it.
Now, this idea of mechanical adjustments, it also applies when we talk about dividends. In fact, probably one of the most common mistakes in analysis is misreading the price drop on an ex-dividend date.
Okay, so what's so interesting here is that you're looking at something that appears to be selling pressure, but it's not. On the morning of the ex-dividend date, the stock exchange itself automatically knocks the share price down by the exact dividend amount. Why? Well, because that cash isn't the company's anymore. It's been set aside for the shareholders. It's an accounting function, plain and simple. It is not a bearish market signal. And this difference is it's absolutely fundamental. If you're only looking at a price return index, which just tracks the stock price, you are ignoring a huge chunk of long-term returns. The institutional standard, the only one that really matters, is the total return index. It assumes you reinvest every dividend. That gives you the only true, complete picture of how an investment has actually performed over time. Okay, so we've covered that prices need to be handled really carefully. But what about the identity of the security itself? This is where things can get, well, surprisingly messy, and it can pose a massive threat to the integrity of any historical data you're using. You know, a lot of people think of a ticker symbol as this permanent name tag for a stock. It's not. It's more like a nickname that can change or even get passed on to a totally different company down the road. For any kind of serious long-term analysis, institutions have to rely on permanent identifiers, things like a FIGI or a CUSIP. These codes stick with a security for its entire life, no matter what. Mergers, acquisitions, you name it. And this is exactly why just using tickers is so risky. Let's say a company changes its ticker. A simple ticker-based database might just stop the old data series right there. This creates what we call phantom exits in a backtest. It breaks your risk models, and it can totally corrupt your entire performance history. It's a huge problem. Which brings us to what might be the sneakiest but most destructive data problem there is. It's a flaw that can make a totally mediocre strategy look like a work of genius, just by ignoring all the things that went wrong. This is the classic picture of survivorship bias. So the story goes, during World War II, analysts were looking at bombers that came back from missions. They'd map out all the bullet holes and say, okay,
let's add more armor here, here, and here. But a statistician named Abraham Wald came along and pointed out the huge flaw in their thinking. They were only looking at the planes that survived. The most important data was on the planes that didn't come back. The real lesson was to put armor where the survivors weren't hit, because a hit in those spots was clearly fatal.
In finance, we see this exact same bias when a historical data set only includes companies that are still around today. You're accidentally filtering out every bankruptcy, every company that got delisted, every failed merger. So what happens? Your backtest results become structurally, and I mean dangerously, optimistic. You're basically analyzing a fantasy world where nobody ever fails, and that is not the world we invest in. So the takeaway is simple, but it's crucial. To get a real, honest picture of historical risk and return, your dataset has to be what we call point-in-time aware. That means it must include all the companies that were in your universe at any point in the past, especially the ones that eventually failed and disappeared. This isn't just a nice to have, it's the absolute non-negotiable institutional standard. So when you put all of this together, the split adjustments, the total return math, using permanent IDs, and avoiding survivorship bias, it all points to one inescapable conclusion. Getting the data right with professional-grade rigor, it isn't just an optional step. It is the absolute bedrock of any valid financial analysis. So let's just quickly recap the big ideas. Splits are cosmetic, dividend drops are purely mechanical, tickers are unreliable nicknames, survivorship bias will flat out lie to you about the past, and maybe the most important thing of all the complex, brilliant modeling in the world is totally worthless if it's built on a foundation of bad data. And that really gets to the heart of it. In the institutional world, finding an edge isn't about some secret formula in a black box. It really starts with an unwavering, almost obsessive commitment to data integrity, to making absolutely sure that the history you are analyzing is the history that actually happened.